It is happening right now, not next quarter, not in some theoretical future scenario that economists debate on television panels. It is happening this month, in April of 2026. And the people it will hurt the most are the ones who have absolutely no idea it is occurring. Money is leaving the American banking system at a scale and speed that has no precedent in the modern financial era. And the institutions that depend on your deposits to function are watching billions of dollars walk out the door every single week, while the mainstream financial press covers stock market fluctuations and misses the structural transformation happening beneath the surface of the entire banking economy. Here's the number you need to hear first. Money market fund assets have hit $8.3 trillion. That is not a misprint. $8.3 trillion is now sitting in money market funds outside the traditional banking system as of late March of 2026, confirmed by Reuters, the Investment Company Institute, JP Morgan Chase, and Crane Data simultaneously. Just 12 months ago, that number was approximately $7 trillion, which means that in 1 year, approximately $1.3 trillion in new money flowed from the banking system and other assets into money market funds. And the acceleration is not slowing. In a single week, in early March of 2026, $49 billion flowed into money market funds in 7 days. $49 billion in 1 week. 18.5 billion of that came in on a single Tuesday as geopolitical uncertainty rippled through markets. That is not individual savers quietly moving modest savings. That is mass institutional and retail capital flight, measured, documented, and confirmed by the most credible financial tracking institutions on the planet. But here is what makes this April different from every prior episode of deposit flight. There are not one but three simultaneous, converging forces pulling money out of the banking system at the same time. Each one alone would be significant. Together, they are creating what financial analysts are privately calling the Great Deposit Migration. A reshuffling of American capital on a scale not seen since the National Banking Act of 1863 restructured American finance after the Civil War. And buried inside each of these three forces is a mechanism that most ordinary depositors have never heard explained clearly. That changes today, because by the end of this video, you will understand exactly what is happening, exactly why it is happening, exactly where the money is going, and exactly what the consequences will be for the banking institutions that survive this transition and the ones that will not. Let us start with the four-stage system, because this is not random. Every major capital migration in financial history follows the same predictable progression, and recognizing the stage you are in is the only way to understand what comes next before it arrives. Stage one is the yield gap opening. Banks are not charities. They exist to take your deposits, pay you a small rate, lend that money out at a higher rate, and keep the spread as profit. This model works brilliantly when the alternatives to keeping money in a bank account pay almost nothing. For over a decade, following the 2008 financial crisis, that was exactly the situation. Interest rates were near zero. Money market funds yielded almost nothing. Government bonds paid almost nothing. Savings accounts paid almost nothing. There was no compelling financial reason to move your money because everything outside a bank paid approximately the same pittance as inside a bank. The banking system had a captive audience of depositors with nowhere more attractive to go. Then in 2022, everything changed. The Federal Reserve began raising interest rates at the fastest pace in 40 years to combat surging inflation. And as rates rose, the yield gap between bank deposits and everything outside the banking system opened dramatically. Banks, particularly large banks, were notoriously slow to pass those higher rates on to depositors. By the time money market funds were paying 4 and 5% on assets, the national average interest rate on a bank savings account was approximately 0.44%. That gap between what you earned keeping money in a bank and what you earned moving it to a money market fund was the opening crack in the foundation. Stage two is the flightiness multiplier. The Federal Reserve Bank of New York published research in July of 2025 documenting something that most people had never thought to measure: deposit flightiness. The concept is straightforward, but its implications are profound. Not all deposits are equally stable. Some depositors, particularly retail customers who have banked at the same institution for decades, are relatively immune to interest rate differentials. They stay put out of inertia, loyalty, and the friction of changing banking relationships. But other depositors, particularly corporate and institutional clients holding large uninsured balances, are extremely sensitive to interest rate differences. They move quickly, they move large amounts. And crucially, the Federal Reserve found that when the banking system expanded its deposit base through quantitative easing, the new deposits that flowed in disproportionately attracted the rate-sensitive variety. The marginal depositor that the system gained during the pandemic era, Stimulus was far more likely to leave at the first sign of a better alternative than the core depositor base that existed before the flood of liquidity. The 2023 regional banking crisis demonstrated this mechanism in terrifying real time. The Fed's research showed that deposits created through reserve expansions disproportionately attract depositors who are more sensitive to interest rate changes than the existing depositor base, raising the aggregate average flightiness of the deposit base across the entire system. In plain language, the banking system's deposit base became more fragile during the pandemic era, precisely because of how much money flowed into it, and now that money is flowing back out. Stage 3 is the structural pull. This is the stage that most financial commentary misses entirely because it requires understanding a piece of legislation that the mainstream media has dramatically underreported. On June 18th of 2025, President Trump signed into law the Guiding and Establishing National Innovation for United States Stablecoins Act, known as the Genius Act. It was the first federal stablecoin law in American history, governing a market that now exceeds $200 billion in total capitalization. And it contains within it a structural mechanism that the American Bankers Association has formally warned could put $6.6 trillion of bank deposits at risk. The Genius Act entered its critical enforcement phase this month, April of 2026. On April 7th, 2026, 3 days ago, the FDIC Board of Directors officially approved a notice of proposed rulemaking to implement the Genius Act requirements for FDIC-supervised institutions. The legal infrastructure for the largest restructuring of American payments in over 160 years is not a future event. It is this week's news. And on that same day, analysis published by Columbia Law School's Blue Sky blog confirmed the figure that is the core of this video's title. Analysis suggests that if stablecoin yield rewards remain unrestricted, the banking system could face a contraction in lending capacity exceeding $1.5 trillion. That figure falls hardest on community banks, which depend on retail deposits to fund relationship-based lending to small businesses and farms. $1.5 trillion, not gradually drained over a decade, potentially contracted within the operational window of this new regulatory regime. And the American Bankers Association, in a January 5th, 2026 letter to the United States Senate, put the overall at-risk deposit figure even higher. $6.6 trillion in bank deposits are at risk from stablecoin competition. Stage 4 is the inevitable reckoning. When three simultaneous forces pull in the same direction, the mathematical outcome is not uncertain. Money market fund assets hit $8.3 trillion as of late March of 2026, and investors pumped $162 billion into those funds in the first 2 months of this year alone. The Genius Act is now in active implementation, with over 40 applications for permitted payment stablecoin issuer status already processed by the Office of the Comptroller of the Currency since the January 2026 compliance kickoff. The FDIC just approved its implementing rules this week. The community banking sector, which holds approximately $20 trillion in total domestic deposits and serves the small business lending backbone of the American economy, is facing the convergence of all three forces simultaneously. The banks that survive this transition will be those with the most diversified, most loyal, and most rate-insensitive deposit bases. The banks that do not will lose the funding foundation that makes their lending model viable. And when banks stop lending, the consequences ripple through every corner of the economy. That is the stage 4 we are entering now. If this analysis is giving you the context that the mainstream financial media is not providing, subscribe right now. Hit that notification bell. Because what we are about to show you in the historical evidence and the current application to your specific financial situation is information you will not get on CNBC or Bloomberg in a form this clearly explained. This channel exists to translate complex systemic financial shifts into the plain language that every depositor, every saver, and every small business owner deserves to understand. The first historical proof is the rise of money market funds in the 1970s and the subsequent savings and loan crisis that it accelerated. This is the closest precedent to what is happening today, and almost nobody connects these two events when explaining what we are experiencing. In the 1970s, Regulation Q in the United States imposed legal caps on the interest rates that banks could pay on deposits. When inflation surged in the mid to late 1970s, those capped rates became laughably inadequate. A depositor earning a regulated 4% on a bank savings account while inflation ran above 10% was effectively losing purchasing power every month by keeping money in the bank. Fidelity Investments and other asset managers began offering money market funds that bypassed Regulation Q entirely. paying market rates on short-term treasury and commercial paper instruments and passing those rates directly to investors. The migration was immediate and dramatic. By the early 1980s, money market funds had grown from negligible size to over $200 billion. That migration drained deposits from savings and loan institutions precisely when those institutions needed stable deposit funding to weather the interest rate shock of the Volcker era. The combination of rising rates, deposit flight, and overconcentration in long-term fixed-rate mortgages made those institutions insolvent. Over 1,000 savings and loan institutions ultimately failed. The deposit migration of the 1970s did not cause the savings and loan crisis alone, but it accelerated the vulnerability of an institution that depended on stable, cheap deposits to fund long-term fixed-rate assets. Sound familiar? Check. Verified. Undeniable. The second historical proof is the events of March 2023. This case study requires understanding a number that most people know, but few have fully absorbed in its implications. When Silicon Valley Bank failed on the 10th of March of 2023, it had spent the prior 18 months watching its deposit base slowly and then suddenly flee. The bank's deposits had swelled during the pandemic era as venture capital-backed technology companies parked massive cash reserves in a single institution. Those deposits were overwhelmingly uninsured, meaning balances above $250,000 that the FDIC does not protect. When the bank announced a loss on securities sales on March 8th, the rate-sensitive institutional depositor base that had been attracted during the expansion of pandemic-era liquidity activated with extraordinary speed. $42 billion left in a single day. The Federal Reserve Bank of New York's research on deposit flightiness, published in July of 2025, analyzed exactly this event and concluded that the flightiness of SVB's deposit base was a direct product of the reserve expansion period that had inflated deposits with rate-sensitive institutional capital. What made 2023's crisis distinctive was not just the failure of 3 major regional banks, but the speed of the deposit flight that preceded each failure. In the digital banking era, $42 billion can leave an institution before regulators have time to arrange an orderly resolution. The contagion spread from Silicon Valley Bank to Signature Bank to First Republic Bank to PacWest to Western Alliance within weeks, not months, as depositors across the entire regional banking sector asked the same question simultaneously: is my bank next? The Federal Reserve had to invoke an emergency systemic risk exception to guarantee all deposits at the failed institutions, regardless of the insurance limit, a step so extraordinary and so politically controversial that its future application in any similar crisis cannot be assumed. The lesson of 2023 is not that the system was fragile once and has since been fixed. The New York Fed's research from July of 2025 confirmed explicitly that the deposit flightiness created by quantitative easing persists in the system. The fragility that caused 2023 has not been resolved. It has been temporarily suppressed. Check. Verified. Undeniable. The third historical proof is the rise of the money market fund complex following the 2008 financial crisis, which established the structural precedent for the current $8.3 trillion mountain of capital now sitting outside the traditional banking system. After the 2008 crisis, the Federal Reserve expanded its balance sheet through rounds of quantitative easing, injecting trillions of dollars into the banking system through reserve creation. Total bank deposits ballooned from approximately $8 trillion in 2007 to over $20 trillion by 2022. That extraordinary growth in the deposit base funded an era of cheap credit, inflated asset prices, and ultimately the commercial real estate overconcentration that now threatens the regional banking sector. But when the Federal Reserve began raising rates in 2022, the institutional logic that had parked trillions in low-yielding bank accounts during the near-zero-rate era inverted. Money market funds began offering 4% and 5%. Bank deposits at large institutions offered fractions of a percent. The migration began and has not stopped. Since the first quarter of 2022, money market fund assets have surged by $3.1 trillion according to the Federal Reserve's own quarterly financial accounts data. $3.1 trillion in 4 years. The vast majority of that migration represented deposits leaving the banking system. And in the fourth quarter of 2025 alone, American households poured $269 billion into money market funds in a single quarter, bringing their total money market fund holdings to a record $5.08 trillion. In all of 2025, households poured $583 billion into money market funds. That happened even as the Federal Reserve was actively cutting interest rates, which should theoretically have made money market funds less attractive relative to bank deposits. The migration continued through the rate cuts because 3 forces now drive it simultaneously. Not just the yield differential, geopolitical uncertainty fueling flight to safety, the Genius Act restructuring the payments architecture, And deposit flightiness baked into the system from a decade of quantitative easing. Check. Verified. Undeniable. Now let us apply every element of this to the present moment, because the convergence is not approaching. It arrived in April of 2026. The money market fund explosion is documented at levels that dwarf anything in prior financial history. Total money market fund assets stand at $8.3 trillion as of late March of 2026, confirmed by Reuters, citing calculations from JP Morgan Chase, the Investment Company Institute, and Crane data simultaneously. In the week ending March 18th of 2026, the Investment Company Institute reported that total money market fund assets increased by $38.68 billion in a single week to $7.86 trillion. Just 2 weeks later, the Bloomberg headline on March 4th reported assets had already climbed to $8.271 trillion as war-related risk fears drove a fresh wave of flight to safety inflows, $49 billion in 1 week, $18.5 billion on a single Tuesday. The cash mountain is growing faster than it did even during the peak of the 2023 banking stress. And it is growing in an environment where the Federal Reserve has been cutting rates, which theoretically should make money market funds less attractive. The fact that the migration is accelerating despite rate cuts tells you that yield differential alone is no longer the driver. What is driving it now is fear, structural change, and the Genius Act, verified. The Genius Act implementation is now a live event, not a future risk. On April 7th of 2026, the FDIC Board of Directors approved its notice of proposed rulemaking implementing the Genius Act for FDIC-supervised institutions. The Office of the Comptroller of the Currency published its own proposed rulemaking on February 25th of 2026. Both agencies are racing toward a July 18th of 2026 deadline to finalize regulations, exactly 1 year after the law was signed. The American Bankers Association warned in its January 5th, 2026 letter to the Senate that $6.6 trillion in bank deposits are at risk from the migration toward stablecoins. Columbia Law School's Blue Sky blog published analysis in January of 2026, confirming that if stablecoin yield rewards remain available through exchange platforms, the banking system faces a potential contraction in lending capacity, exceeding $1.5 trillion, with the impact falling hardest on community banks that depend on retail deposits. The Bank Policy Institute, which represents the largest American banks, published its own analysis, warning that stablecoin competition creates a powerful incentive for deposit flight, siphoning low-cost retail deposits away from banks and representing a net contraction in the credit most vital for local economic growth. Check. The three simultaneous triggers are converging in April. First, geopolitical uncertainty from the conflict that began in late February has driven unprecedented weekly inflows into money market funds, as investors prioritize capital preservation over yield optimization. Second, the Genius Act implementation is entering its enforcement phase this month, with the FDIC's proposed rules approved on April 7th and the OCC rules finalized in February, creating regulatory clarity that will accelerate stablecoin adoption as an alternative to bank deposits. Third, the Federal Reserve's rate-cutting cycle, which began in late 2024 with 3 quarter-point cuts, is reducing the yield differential between money market funds and bank deposits. But it is doing so just as stablecoins are offering a new technological infrastructure that bypasses the traditional bank deposit model entirely. Every element that could drive deposit migration is activating simultaneously. The banks most vulnerable are the ones the American economy depends on most. Community institutions with concentrated geographic footprints, heavy small business lending books, and retail deposit bases that will be first to encounter the marketing of digital wallets and stablecoin payment platforms as everyday substitutes for traditional checking and savings accounts. Undeniable. Now, let us address what this means practically and what the arguments against it miss. The first argument against this analysis is that stablecoins are still a niche technology that most ordinary Americans have never used and will not use soon. This argument would have been completely valid in 2023. It is increasingly invalid in 2026. The Genius Act's implementation is specifically designed to accelerate mainstream adoption by providing the regulatory certainty that major financial institutions and technology platforms require before integrating stablecoin payments into their consumer products. JP Morgan Chase has already executed what analysts are describing as a stunning strategic pivot toward public blockchain integration. Stablecoins are not niche. They are already processing more transaction volume than the largest payment network in the world. The migration from ordinary payment rails to stablecoin rails is not a futuristic prospect. It is already underway at institutional scale. The second argument is that money market funds are themselves part of the financial system and pose their own risks, so moving money there does not solve anything. This is partially true and entirely beside the point of what is actually happening. The risk profile of money market funds, particularly government money market funds that invest in United States Treasury securities and agency securities, is fundamentally different from the risk profile of a bank deposit at a regional institution with concentrated commercial real estate exposure and large unrealized losses on its securities portfolio. The Federal Reserve's analysis of the 2023 crisis documented explicitly that money market funds look safer than bank uninsured deposits from the perspective of a sophisticated depositor. JP Morgan analysts stated this directly in a note during the 2023 crisis. Not only are money market funds offering superior yields, but they also look safer than bank uninsured deposits. That perception, whether or not it is perfectly accurate in every scenario, is what drives capital flows. And when $8.3 trillion has moved to reflect that perception, the institutional reality it creates in terms of banking system funding is independent of any theoretical debate about relative safety. The third argument is that the Federal Reserve will intervene before any significant disruption occurs. This argument requires belief in two things that are not guaranteed. First, that the Federal Reserve has the tools to stop a structural transformation in how Americans use money for payments and savings, when that transformation is being legally facilitated and actively encouraged by federal legislation. The Genius Act was signed by the President. Its implementing rules are being written by the FDIC, the OCC, and the Federal Reserve itself. The central bank is not in opposition to this transformation. It is writing its enabling regulations. Second, that the Federal Reserve's intervention capacity in a deposit migration driven by legal and structural change, rather than panic, is the same as its capacity in a liquidity crisis. In a liquidity crisis, the Fed can provide emergency lending. But when deposits leave the banking system through legally facilitated channels to legally established alternatives, that is not a crisis the Fed stops with emergency liquidity. That is a structural transformation it navigates alongside, not against. The fourth argument is that this is all speculative, and the $1.5 trillion figure is just an estimate. This is accurate and also the wrong framework for evaluating the risk. The $1.5 trillion figure comes from analysis published by the Bank Policy Institute and cited by Columbia Law School's Blue Sky blog in January of 2026. The $6.6 trillion figure comes from the Treasury Department's own April report, estimating maximum stablecoin deposit outflows. The American Bankers Association's $6.6 trillion warning is not the estimate of critics, but the organization representing the largest and most sophisticated banking institutions in the United States, telling the United States Senate that this is the number they are worried about. When the ABA writes a formal letter to the Senate warning of $6.6 trillion at risk, that is not conspiracy theorizing. That is the banking lobby's official assessment of the structural threat it is facing. So what do you actually do with this information? First, understand the specific vulnerability of your current banking institution. Not all banks face equal exposure to deposit migration. Large money center banks with diversified revenue streams, global operations, and sticky institutional relationships are better positioned to weather deposit migration than community banks that depend almost entirely on local retail deposits to fund their lending. A community bank losing 20% of its retail deposit base to stablecoins and money market funds faces a fundamentally different funding equation than JP Morgan Chase doing the same. If you bank with a smaller community institution, understanding its deposit concentration and funding profile is more important now than at any point since 2023. Second, understand what the FDIC insurance limit means and where it applies. $250,000 per depositor per institution per account category is the limit. Money market funds that invest in government securities are not bank deposits and do not carry FDIC insurance. But government money market funds hold assets, United States Treasury securities, that are backed by the full faith and credit of the United States government. The risk profile is different from a bank deposit, not necessarily inferior. The critical distinction is understanding exactly what you own when you hold a money market fund versus a bank deposit versus a stablecoin. Each has a different legal structure, a different risk profile, and a different regulatory framework. Stablecoins under the Genius Act are explicitly not bank deposits and do not carry FDIC pass-through insurance to individual token holders, confirmed by the FDIC's own clarification issued this month. Third, monitor where your bank sits in the funding vulnerability spectrum. Banks with high proportions of uninsured deposits, meaning deposits above the $250,000 FDIC limit, are most vulnerable to rapid flight in a stress event. The Federal Reserve Bank of New York's research on deposit flightiness confirmed that uninsured leverage, the ratio of uninsured deposits to total assets, is among the most predictive factors of whether a stress event triggers a full deposit flight. These statistics are publicly available in each bank's quarterly call report filed with federal regulators. Fourth, recognize that the April 2026 moment is a structural inflection point, not a temporary volatility event. The $8.3 trillion in money market funds is not going to reverse into bank deposits when geopolitical uncertainty eases. The Genius Act is law. Its implementing regulations are being finalized this month. The stablecoin market is growing. The structural pull on deposits is not cyclical. It is directional and it is accelerating. Fifth, understand the knock-on effects for credit availability. When banks lose deposits, they lose the funding that enables them to lend. The Bank Policy Institute's warning was explicit. The migration of core deposits from community banks would represent a net contraction in the credit most vital for local economic growth. That means small business loans become harder to obtain and more expensive. Mortgage lending from community lenders tightens. Agricultural lending in rural communities contracts. The economic consequences of the deposit migration are not confined to the balance sheets of banking institutions. They ripple through the communities those institutions serve. Here is the synthesis of everything this video has demonstrated. The $1.5 trillion figure in the title represents the specific banking sector lending capacity contraction, documented by the Bank Policy Institute and Columbia Law School as the minimum consequence of the stablecoin yield competition enabled by the Genius Act's implementation, which entered its critical enforcement phase this April. It sits within the larger context of $8.3 trillion in total money market fund assets, $3.1 trillion of which migrated from the banking system since the first quarter of 2022. The three converging forces driving the April 2026 acceleration, geopolitical flight to safety, Genius Act structural restructuring, and Federal Reserve rate cutting reducing yield differential defenses, have not existed simultaneously before this month. The historical precedents from the savings and loan crisis to the 2023 banking stress confirm that when deposit bases migrate at scale in concentrated periods, the institutions most vulnerable are the ones that cannot survive, losing a critical percentage of their funding without contracting credit or seeking emergency capital. The American banking system is not collapsing, but a transformation of how Americans store and move money that is as significant as any financial development in a century and a half is activating right now. The people who understand what is happening can make deliberate, informed decisions about their own deposits, their banking relationships, and their exposure to the institutions most affected. The people who do not understand will read the headlines about the next regional bank stress event and wonder where it came from. It came from this. It came from April of 2026. It came from three converging forces that the mainstream media is covering separately and that nobody is connecting into the unified picture that explains why $1.5 trillion is quietly leaving the banking system right now. Subscribe to this channel, share this video with anyone who has money in a bank account, which means share it with everyone you know. The next video in this series will document which specific categories of banking institution face the highest deposit vulnerability, how to read a bank's call report to assess its funding stability, and what the historical timeline looks like between the start of a structural deposit migration and the first visible institutional consequences. You do not want to miss it, because the clock on this transformation has already started. Let me show you one more dimension of this story before we close. Because the true scale of what is happening becomes visible only when you compare these simultaneous deposit migration streams to the total size of the American banking system and understand what percentage contraction is already in motion. American commercial banks held approximately $20 trillion in total domestic deposits as of the most recent Federal Reserve data. $3.1 trillion has already moved to money market funds since the first quarter of 2022. That is roughly 15% of the entire deposit base that has already exited the system in 4 years through one channel alone. Now layer in the stablecoin migration that is accelerating under Genius Act implementation. The American Bankers Association warns that $6.6 trillion of deposits are at risk. That represents 33% of the total deposit base, not a rounding error, not a niche disruption. 1/3 of the entire funding foundation of the American banking system is formally assessed by the banking industry's own representative body as being at risk of migration to digital payment alternatives. And the Columbia Law School analysis does not treat the $6.6 trillion figure as the probable outcome. It treats $1.5 trillion as the minimum lending capacity contraction if stablecoin yield rewards remain available through exchange platforms. The minimum, the floor, not the ceiling. Now consider what the Federal Reserve Bank of New York told us about deposit flightiness in its July 2025 research publication. The key finding was this: deposits created through reserve expansions disproportionately attract depositors who are more sensitive to interest rate changes than the existing depositor base, raising the aggregate flightiness of the overall deposit base. The pandemic era quantitative easing, which expanded the Federal Reserve's balance sheet from approximately $4 trillion before the pandemic to approximately $9 trillion at its peak in 2022, injected approximately $5 trillion in additional reserves into the banking system. The deposits created by that reserve expansion are exactly the category of deposits the New York Fed identified as disproportionately flighty. They are the deposits now migrating to money market funds. They are the deposits most likely to migrate to stablecoins, as those become accessible through mainstream platforms. The banking system built its pandemic-era deposit base on a foundation of rate-sensitive, technologically sophisticated institutional and corporate capital that was always more likely to leave than the traditional retail depositor base it supplemented. The comparison that the Financial Content Analysis published on April 9th of 2026 made is historically illuminating. The rise of money market funds in the 1970s drew deposits away from traditional banks on a timeline that ultimately contributed to the savings and loan crisis. That migration took approximately a decade to reach its full destructive force. The stablecoin migration is operating on a compressed timeline driven by legislative mandate and technological acceleration, 8 months to full legal framework. 18 months to full enforcement. The velocity is not comparable to the 1970s precedent. It is dramatically faster. And the institution that is supposed to protect you through all of this, the FDIC, clarified something important this week that almost no financial news source emphasized. When it approved its Genius Act proposed rulemaking on April 7th, the FDIC simultaneously confirmed that while stablecoin reserves held at banks as institutional deposits are insured at the corporate level, individual token holders will not receive pass-through deposit insurance protection. Your bank deposit is insured up to $250,000 by the FDIC. A stablecoin token that you hold in a digital wallet, even if the underlying reserves are held at an FDIC-insured institution, does not give you that same direct insurance protection. The stablecoin issuer's reserves may be insured. Your token is not. This is not a minor technical distinction. It is a fundamental structural difference in the legal protection available to you. As stablecoins become mainstream payment instruments, and as ordinary people are encouraged to move money from traditional bank accounts into digital wallets for everyday transactions, the insurance gap will become a critical consumer protection issue that most people will not discover until something goes wrong. What this all means for you, the person watching this right now, is that April of 2026 is a structural decision point. The financial landscape that existed before this month will not exist in the same form 12 months from now. The banking system will be smaller in terms of deposit base. Community banks will have less funding available for local lending. Stablecoins will be more integrated into everyday commerce. Money market funds will continue holding an extraordinary share of American liquid savings. The question is not whether these changes are happening. They are confirmed, documented, and legally mandated. The question is whether you are positioned to understand them and respond deliberately, or whether you discover them after their consequences have already materialized in your banking relationship, your credit access, or your community's economic vitality. The $8.3 trillion mountain of cash and money market funds did not appear by accident. The $1.5 trillion minimum lending capacity contraction projected by banking industry analysts did not appear in regulatory filings by coincidence. The FDIC's April 7th rulemaking did not arrive without warning. Every data point, every research publication, every regulatory filing, every industry warning letter has been building toward this moment. April of 2026 is the month when theory became implementation, when the Genius Act moved from legislative history to operational reality, when the money market fund mountain crossed $8 trillion for the first time, when the FDIC approved its implementing rules, when $49 billion moved into money market funds in a single week. The lockdown this title refers to is not a dramatic seizure. It is a quiet, legal, mathematically inevitable process by which the banking system loses the deposit funding it needs to function at its current scale. Not suddenly, not with alarm bells, but steadily, weekly, one capital migration decision at a time. until the aggregate contraction becomes impossible to ignore. By then, the window to act with full information will have closed. It is open right now. Subscribe. Share this with someone who keeps all their savings in a bank account without understanding what is happening to the system that holds those savings. Because the most expensive ignorance in personal finance is not knowing what you do not know until it costs you something you cannot recover. And what is quietly leaving the banking system this April is not just money. It is the structural stability that the previous generation of American financial life was built on. Understanding that is how you navigate what comes next.